Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets that companies try to bury in mountains of paperwork. Today we're digging into Molson Coors Beverage Company's latest announcement, which, let's just say, involves some rather significant shakeups.
Now, you might think a company like Molson Coors, known for its popular beers, is just about brewing and selling drinks. But like any giant corporation, they also have to file official reports with the government, telling everyone what is going on. And this report from the 20th of October 2025 has some interesting news.
So, what is this big news? Well, Molson Coors is announcing a major restructuring plan. They're aiming to make their Americas operations leaner and more agile, which sounds like corporate speak for getting rid of some people and streamlining things. They plan to eliminate about 400 salaried positions across their Americas business by the end of December 2025. That is roughly 9% of their salaried workforce in that region. Now, some of these positions were already open because they were prioritizing other tasks, and some employees might even be offered voluntary severance. This kind of move always comes with a price tag. Molson Coors says they expect to spend between $35 million and $50 million on these restructuring charges. Most of this will be in cash and will be related to severance pay and benefits for the employees who are leaving. They figure most of this cash will be spent over the next 12 months. It's important to remember these are estimates. And the actual costs could be different, depending on how many people take the voluntary severance packages.
Now, alongside this news, they've also released a press release. Think of this as their official statement to the public about what is happening. This release, which is attached as an exhibit to their filing, provides more details about this restructuring.
Because this report talks about future plans and expectations, it is filled with what they call forward-looking statements. These are essentially educated guesses about what might happen. Words like expects, plans, anticipate, and potential are big clues here. They're saying what they think will happen, but they also make it clear that things could turn out differently.
They mention that factors like increased restructuring costs or difficulty keeping key employees could impact their results. They're essentially telling investors to be cautious because the future is never guaranteed.
Looking at the securities this company has registered for trading, we see their Class A common stock, traded under the ticker APLA, and their Class B common stock, traded as Apple. It is interesting to note, they also have senior notes due in 2032, which are essentially company loans that mature then.
This tells us they use a mix of stock and debt to finance their operations, which is pretty standard for large companies. Their Class A common stock and Class B common stock are both listed on the New York Stock Exchange, a major exchange. The senior notes due 2032 are also traded on the New York Stock Exchange. This is good to see as it means their securities are readily available for investors to trade. Having those senior notes means they have debt obligations. The 3.800% rate tells us how much interest they're paying on that specific debt. It is a fixed rate, meaning it won't change over time, offering some predictability in their interest expenses.
The currency used for these notes and likely for much of their financial reporting is the US dollar. This is pretty standard for a company primarily operating in North America, even though they have a global presence. When we see terms related to shares, it is usually about the number of shares outstanding or the total number of shares the company has authorized. This is important for understanding ownership and potential dilution if new shares are issued. So, what is the takeaway from all of this? Molson Coors is undergoing a significant internal overhaul. They're cutting jobs to become more efficient.
This is a tough, but sometimes necessary move for companies to stay competitive in a changing market. The significant restructuring costs of $35 to $50 million are a clear indication of the scale of this change. Looking at the broader picture, Molson Coors is a well-established player in the beverage industry.
Their decision to restructure suggests they are proactively addressing challenges and looking for ways to improve profitability. The fact that they are using a mix of stock and debt financing and are listed on major exchanges shows they are a mature and publicly traded company. However, the risks mentioned in their forward-looking statements are worth noting.
Any major organizational change can lead to unforeseen costs and challenges, especially in retaining talented employees. Investors will be watching closely to see if this restructuring delivers the expected benefits without causing too much disruption. In conclusion, Molson Coors Beverage Company is making a decisive move to reshape its Americas operations. While the financial impact of the restructuring charges is clear, the long-term benefits will only become apparent over time. The company needs to execute this plan smoothly to maximize its advantages and minimize any negative consequences.
All right.
That is our breakdown of Molson Coors' latest filing. What is your take on these restructuring plans and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description for more exclusive content and discussions.
Thanks for watching. See you next time.